we're setting ourselves up to win here, though, today, aren't we?
I mean, that's another, we'll just roughly call it 50%. I mean, do you see that as a viable scenario?
That's not in touch with any empirical reality that I'm acquainted with, but we're going to get a 25 basis cut today.
We are.
Yeah, and I think the big thing, we're also going to see...
You said it very matter-of-factly, Joe.
Yeah.
We're getting a cut. I wrote the damn bill.
We priced it in, and we're not quite Bernie-esque about it, but I think we are going to see the end of quantitative tightening, which I don't think that the market's fully priced in.
Okay, explain that. It's early. What do you mean, the end of quantitative tightening?
The reduction in the pace of balance sheet the pace of balance sheet reduction will move to zero. That means the balance sheet's going to be static for a good period of time until it's necessary for the Fed to begin purchasing assets, which one would think they would do if we end up in a recession in a year or two. But for now, we're going to stop. That's a very good thing. It will help with liquidity conditions. You talk to specialists in the market, they've been complaining about liquidity conditions for a number of months. So we're going to see that end. I think that's positive, and we'll see how the market responds this morning.
Oh, the president's saying, I was right, back in December when they raised rates and the market went haywire, we dropped like 18%. Do you feel like this will be a one-and-done cut to sort of reverse December, or is this the beginning of cut?
So our baseline is two cuts. One today and then another in September, because we're likely to see the rollover from the slowdown in European and global manufacturing. I mean, we're teetering on an auto inventory correction here in the United States as we speak. And let's face it, the yield curve reset so low that the models at the Fed change, and they do feel that they have to end up cutting to provide a little cushion against the global headwinds, which, as we just saw from Willem over in Europe, are mounting.
Goldman Sachs argued in a note a couple of weeks ago that we don't need to pay as much attention to manufacturing data as we used to, and maybe a cut is not warranted.
Okay, so we disagree with that. While manufacturing is only 11% of the economy, it supports a broad array of service jobs. And especially when we begin to see a deceleration in industrial production linked to auto production, and then, of course, aerospace manufacturing. Those impact broad parts of the economy. And I think that you do want to watch that. They do cause variation quarter to quarter in growth domestic product. We saw that in the recent weeks, and I'm expecting to see it again through the second half of the year.
Well, look at Dow futures. They're up 77 points. I mean, that's a plain grilled chicken sandwich. Not too much to get excited about. If we're going to get a cut today, why isn't the equity market reacting a little more strongly? Where's that 10,000-point rally, Joe?
Well, I think it's been priced in over the past month since Mr. Powell basically told us at the last meeting.
Certainly has.
Oh, yeah, sure. And that's the market that I tend to watch the most closely. But, hey, look, when he goes out there and gives that presser today, if he talks very, very dovish and he really explains why they're stopping balance sheet reduction, you can probably see that equity market.
So it's not really the cut. We know that. It's what they say.
That's exactly
Super dovish
right.
Powell means maybe another leg in equities? Not 10,000 points, but...
Well, look, the whole point of what they're doing is to push people into risk assets. So I would think that they're going to accomplish their objective this afternoon.